Welcome back, traders. This is Sandra with Trading Made Simple, and today we're going to talk about butterfly spreads for earnings. Say that 5 times really quick. Butterfly spreads for earnings. So yesterday, some members and I were looking over Netflix. The price at the time was about $3.20, and when I looked over at the trade tab to take a look at the IV, it was about at 215%. That's really high comparably, right? When you look at its normal IV implied volatility at around the 40 range. At the time, the expected range for earnings was $30. So while looking at the chart, um, we started to identify the lower range as well as the higher range and thought, let's do it 20 instead of 30. Let's just do it 20. And you know that trading a lot is, based on your own experience and education, a lot of nuances. It's very subjective. So instead of taking the entire $30 expected move, I took 20. And I did take a $30 expected move on the lower end of it. So basically 2 butterflies. Now, the call butterfly cost $23 for each butterfly, and the lower butterfly cost me $25. And you could see that yesterday it was a little bit more expensive. Yesterday it looked like it was going down. So earnings comes out, great earning report, and we gap up today. So as you could see right now, we are hanging around the 340 range. So when we now look at the Analyze tab, and you can see where price is with that gold line, you can see that we're basically pinning Netflix there. And so what once was $23 to purchase is now $309 to sell. So I want to talk a little bit more about utilizing these type of inexpensive trades. So if you're liking this type of content, please like, subscribe, and share. It really does help my channel get exposed. So now let's get to it. So we're buying something for $23 and we're able to make up to $4.23 as time decays. And why is that? Well, that's because of the way that the trade is structured. You're buying one call. So my pinning price in my mind yesterday was 340. So I'm buying a call that's underneath 340. So I did a $5 wide butterfly. So I bought a 335 call. I sold the two 340 calls, and then I bought the 345 call. So you're going to have a call above it. You're going to have your pinning price, which is the center strike that you always sell. So there was two there that you sell, and then you buy one that's below the price. And that's what's created as this butterfly or a hat, a witch's hat, I don't know, whatever you want to call it. But they are considered butterflies. And when you go into your trade tab, you could see where the implied volatility is at. And one of the reasons why earnings plays don't often work when just buying options is because the IV is so high. So if you didn't have an education about how options work and you didn't know that when IV is really high, the price of the option is really expensive. And as soon as the actual event occurs, IV then crushes. That's what it's called. It's an IV crush. And what then happened to your option call or your option put that you purchased? Well, it goes down in value. So now it's worth nothing, even though the price, let's say you bought the call, price ended up going in the direction that you thought it would be going. IV actually has to stay high in order for your premium to stay large. But if you buy something where the IV is really high, and then there's an IV crush, like there has been today, down at 72, then that means that your calls now are worth barely nothing. And so when we go back now and take a look at the butterfly, you can see that, let's see, how okay, so let's see here. I got rid of mine when it was at 550%. Uh, and I have a member in there right now that's actually, he's probably got out because he was going to get out at $3. And so that's probably about 1,300% he made. Uh, so he did really good. I think I had mine, it breached that 335 area. And so I got rid of mine as soon as it kind of touched that left wing. And as it did that, it was later still in the afternoon. So I still ended up making 550%, which was only, by the way, $1.50. $23 to make $150, where he actually ended up going just below the wing a little and came back, and the rest of the day he's been pinning it. I'm hoping he stays in it. He can, easily make $400 here. You could see that this is on thinkorswim. If you go to your analyze risk profile, you can see where the blue line is your trade and the pink line is theta decay. And so as time is passing, your purple line starts to get higher and higher. And the diagram of your trade, right, is visually there, so you could see it. And so as this is getting higher, you could see where price then starts to, basically keep rising. And so this trade was worth $477 at its peak reward. And this is how you would take advantage, right, of an earnings trade that you want to get into, but you did not end up entering the trade a couple days before when the IV was at a reasonable, range for you to get in. So the next time that you actually see the IV going crazy because of an event that's going to occur, just know that right after the event, that the IV is going to crush. And I know that if you've ever experienced this before on FOMC days or whatever, and you're like, hey, I bought a call, SPY's going up, what's the issue? Well, the issue is the IV crashed. And so is your call, even though it's going in the right direction. And so I think knowing this will really help you in the future, because now you'll be able to create a trade, right, where you're actually utilizing IV. And the only way that you utilize IV is to sell options. So what this does is allows you to sell two. We sold the two 340s. We bought a 345. We bought a 335. And that's how that butterfly is created. And at the end of the day, even though IV was so high, because we ended up selling these 340s, we got a lot of money for those 340s. And we purchased those two calls. And so it makes a very inexpensive trade with the possibility of making, 1,500% off of the trade. It's really incredible. It's a great tool to learn. I hope this information was helpful. I hope that it just expands, the way that you're looking at earnings trades and how implied volatility, how it affects the trade that you're about to take. And so we have a lot of earnings coming up, and this is a fun time to be trading during earnings season. If you're wanting to learn more, come on over to Trading Made Simple. Our contact information is in the description below, and we will see you in the next video.